I've been Sobanski with One Stop Financial Group, here to discuss the steps needed to get you a pre-approval written. Now, there are three things that we verify when we are issuing a pre-approval, determining how much house you qualify for. Those three things are your debt to income ratio, your credit score, and your available assets. Your debt to income ratio includes your financial obligations every month, right? So cars, credit cards, student loans, things like that. We add that together with your projected housing payment, and then we compare that to your qualifying monthly income. What does that mean to you, right? It means the more stuff you have financed, the more monthly payments you have, the less house you're going to qualify for. So it's important that while we're preparing to buy a house, no matter how long that's going to take, that we make sure that we're only financing things that are absolutely necessary. The second thing we look at is your credit score. We're going to pull what we refer to as a tri-merge credit report, meaning we're pulling a score from three separate bureaus. Those bureaus are Equifax, Experian, and TransUnion. And they use their own algorithms to give us your credit score. That's why sometimes you're going to find that your mortgage credit score may vary a little bit from what you see on consumer sites or what you saw when you went to buy a car or you went to buy a boat. They just use and weigh different things a little differently. Now, once we have those three credit scores, we're going to take the median score, meaning your middle score. So if you have a 700, a 710, and a 720, we're going to use the 710. If there are two buyers buying the house, we're going to determine each of your credit scores individually the same way, right? Three scores, taking the middle score. But then with both of you on the loan, we're going to qualify you with the lower of the two credit scores. So you want to make sure that if there are multiple of you, that everybody is taking care of their credit so that the lower score can be higher and we can qualify you for better programs. Lastly, we're going to look at your available assets. These are assets that we can verify, assets that have a paper trail, that are in a checking, in a savings, inside of a retirement account. We can't use like physical cash. We got to make sure that that cash is in the bank and it's seasoned. And we have to make sure that we can verify enough assets to cover your total out-of-pocket costs. Your total out-of-pocket costs are going to be your down payment plus your closing costs plus whatever escrow account we have to set up if you choose to escrow your taxes and your homeowner's insurance. Now, if you have any questions about any of that stuff more individually, please feel free to reach out. Our contact information is in the description below. Reach out anytime. We're happy to help.